What should an investor do if home prices continue to go up and wages don't? So I'm going to talk about a few things here that apply to investors, not home buyers. All right, so some of the concepts would matter to a home buyer, but my channel, my content is specifically designed for the person who wants to reach financial freedom. My goal is to teach you that the average person can reach financial freedom in 10 years or less and make work completely optional, even if you're not starting from the best position. So I often share my story of how I wasn't in a great position, didn't start investing until 40, and then within 10 years made work optional, really liked my job, so didn't retire until after investing for 12 years, but last year I retired. And my entire life, born in the 70s, I've heard people say home prices continue to go up, but wages aren't. So what do we do as an investor? Does it mean that if you're not making a lot of money, you just can't possibly reach financial freedom? Because my goal is to teach you that the average person can reach financial freedom in 10 years or less and make work optional, even if you're not starting from the best position. The average person, not somebody making a lot of money. There are people making $250,000 a year. I think the statistic I saw recently is 1/3 of the people making more than $250,000 a year are living paycheck to paycheck. So those are people that might not reach financial freedom, even though they're making a significant amount of money. The average income is less than $100,000 a year. I've heard family income in the 70s. It depends on which data source you're getting it from. But I want to share my opinion on what we should do, a three-pronged approach that an investor can do to beat the housing affordability index problem. The data clearly shows that home prices are going up and wages aren't. So I want to make sure that we're talking about the right data. If you Google home prices versus wages, you're going to see a lot of charts that started in the 1970s, and they go up and they do some spiky things. But what I want to do is the most recent time in our history where home prices and wages were the closest together, where it seemed like it was the most affordable. And for me, that is home prices are rising faster than incomes. So this is the data from from a Redfin census that shows starting at around 2013. In 2008, we had the stock market crash. Toxic debt in real estate caused a crash. It got really bad, went down for about 4 years. From 2008, 2011 was basically the bottom of the market. I got my first duplex around 2013, where if we look at this data, this was the point in time where home price values and income were about as close together as they're going to get. So if we track this going forward, it only seems like it's exponentially getting worse and worse and worse. I've made a few videos where I've talked about where I see a flaw in the housing affordability index that specifically starts around 2020 and 2021. This was the first time in the history of home ownership that remote work was as possible as it is now. So I think that if you're outside of a major city where most of the work hubs were, where the higher incomes needed to exist for people to be able to afford to live there or afford the cost of commuting there, that's where the biggest income was. Well, now with remote work being as big of an option as it is, I've actually gone through the data of the people that I know, and I know quite a few people. And I'm going to take out truck drivers because for the last decade I ran a CDL school, so I know a lot of truck drivers. And it's kind of hard to remote truck drive as a job. So we're going to take that out of the equation. But of all of the people that I know that have jobs that aren't truck drivers, about half of them are working remotely. And if we go back 15 years, I probably knew 1 or 2 people working remotely. Now it's half, and most of them are making more than $25 an hour with remote jobs. There are a lot of places in the country where you can go where that $25 brings the housing affordability and the income closer together. So it's still possible to be done today. So one of the 3 things that we can do to beat this problem of home prices going up much more than wages are is to make sure we're looking at the right data. Don't look at averages. Look at your income in the market that you're in. If your income is below the median income for that area, why are you there? What's keeping you there? The biggest thing I usually hear is friends and family are here. Well, you're going to make friends other places, and family can travel to see you. How often do you actually go see your family? There are some people who see them often. There are some people who see each other every few months, and actually living farther apart might make you see each other more. So choosing where you live is a way to impact how much we think our income compares to the housing price. The other thing I want to talk about is for that, and you just saw the data on what happened to home prices over the last decade. How many times in the last 5 years have you seen every other day a new Crash Bros video or Crash Sisters video talking about, here's the new reason? This week it's shadow debt and housing delinquencies, which are still at record lows for decades. But the numbers increase, and a small number that increases percentile-wise will look large because it's easier to show a big percentage increase on a smaller number. So it sounds scary. But the reason homes cost more, and I'm going to be making a video soon on this, isn't for the reasons people think. Here's an example. If in 2018 or 2017, you went to buy a used car, you can actually go to kellybluebook.com, the website, or in the old dinosaur days, we had Kelley Blue books that were out that had the estimated value of a vehicle based on depreciation, mileage, the state of the vehicle, the type of vehicle it was, right? You could look up the actual make and model, what year, look at the mileage, and it would tell you pretty accurately what it was worth. Now, car lots would pay you less because they need a margin to sell it, but other people could use it. Lenders would use that number to determine if they were going to loan on the vehicle or not. In 2020 and 2021, not because of the pandemic, but there was a big shift in the type of vehicles people were buying. And this shift in the type of vehicle people were buying made new car production grind to a halt. And since there were no more new cars being made, old cars cost more. The Blue Book value meant almost nothing because if you wanted to go and buy a new car, I actually had a friend who made money by going and buying new cars, not taking it off the lot, leaving it there, so that when it was ready to be picked up, he would go and find somebody at that lot that wanted to buy it, let all of the salesmen know that if there's somebody here who wants to buy the car but doesn't want to wait 6 months because new car production has ground to a halt, they can have my car for a $5,000 fee. And my friend that reached out was asking me if I wanted to invest in this, and he did this on 3 or 4 cars to make the money. So here's what happened, and here's why home prices are continuing to go up. With cars, on an average vehicle, there's around 300 microchips. In the late teens, 20 teens, 18, 19, and 20, there was a big push in a lot of states to go to electric vehicles, hybrids. Well, the average hybrid in the average electric vehicle has over 3,000 microchips. So it wasn't that we couldn't produce the microchips. It was that the demand for microchips went up 10 times. So car production was ground to a halt, making the car values go up. Here is what has happened to home building since 2008. Every decade from 1970 to 80, 80 to 90, 90 to 2000, 2000 to 2010, we built more than 25 million homes every single decade, 4 decades in a row, to try to keep up with demand. Then we had the housing crash and recession that hit in 2008. Builders basically went away. Building ground to a halt. What happened with used car prices? They went up. The luxury of buying a new car and not having to wait 6 months for it made prices go up on new cars. And people could charge a surcharge just because they had one that you can have that you didn't have to wait for. We've seen home prices increase over the last decade from lows, right? 2011 was the bottom of the market since 2008. So they have gone up since then. 2013, they started to pass where they were in 2008. And every single year we heard home prices are so high, it has to crash. This is unsustainable because people were thinking of the average income and the average home cost, not thinking about remote work and how that impacted it. So I want you to think about the number of homes being built, grinding to a halt, increasing the demand on already existing houses. And in that video, I'm actually going to explain how the high cost of housing isn't investors and isn't hedge funds, and it isn't other home buyers. That isn't why home prices are so high. I'll make that video next week. So now you see there is a limited supply on the housing that we have. Home prices have continued to go up. So we have this very limited supply. Now you have this thing called a rate lock. There are 90% of mortgages are under 6%, 70% are under 4%, and around 23% are under 3% on their mortgage. So the move-up buyer has been stopped in their tracks. Selling a small house to buy a bigger house at double the interest rate doesn't make sense for a lot of people. The move down person reaching retirement doesn't make sense, because if you want to sell the big house to get a smaller house, but the interest rate doubles, you're actually not going to be saving much money. And then 40% of homes don't even have a mortgage on them. So moving or trading or buying or selling and moving to a 7 or 8% interest rate has you locked in place with that home ownership. So limited building, limited sales transactions happening. We're actually less than 4 million transactions on track to do when we normally do 6 million. So we've lost about a third of the transactions. So when people talk real estate crash, I agree. We have a crash in transactions, not prices. So what do we do going forward if home prices are going to continue to go up? Now, the crash bros eventually will be right. There will be some black swan event that we can't predict that will cause a crash. It isn't going to happen in 3 months, and it isn't going to happen in a year. The largest 1 year ever reduction in home values that we've ever seen in a 12-month period was 8.9%. Remember, to get that housing crash we had from 2008 took all the way to 2011 to hit the bottom. So even if a crash started, it's years before it gets down to where an actual price reduction will have an impact on your monthly payment. So what do we do if home prices continue to go up and our wages don't? Well, the first thing I want you to consider is that remote work option. I'm not saying get a remote job. I'm talking about if you are making less than $50,000 a year, why are you in a high cost of living area? When the average entry-level truck driver position now starts at $70,000 a year, why would you ever be making less than that doing a job? If you are starting with a part-time or a fast food job because you just got out of school, sure. The first thing I'm going to tell you is that when we see wages increasing over time, on this chart that I shared, this is annual cost of living wages. So remote work's a factor, but are you not also learning a skill or a trade to be more attractive to your employer to get a bigger raise than just a cost of living raise? Are you climbing the corporate ladder? Or, as we've learned in the last couple of decades, are you changing employers? Because changing employers could be a bigger increase than staying at the same company. Are you like taking advantage of some of the easiest ways in my entire life to develop money as a side hustle with Etsy, YouTube, affiliate links, all of the online ways that you can make money that just didn't exist before? Or do you get home from work, you're exhausted, and you think you've worked hard, you deserve to Netflix and chill? Sure, if you want your wages to increase like this. So one of the first things that I want you to focus on is what can you do to increase your income so that you're not just getting that annual cost of living raise. Not everybody can do that. And yes, every person can sit back right now and think of reasons, which I'll call excuses, to not be able to increase your income. I was a single parent. I was working full-time and I worked overtime, but the more overtime I worked, the less time I spent with my kids. So I actually played World of Warcraft and played with my kids and then sold things online. So I actually got time with the family that generated income. Maybe you have a hobby that you can monetize. That won't take away your family time. Haven't figured out how to get paid to watch Netflix yet, but I'm sure there's a way to figure that out. Twitch streamers, let me know. There's probably a way. So first, what can you do to increase your income? Second, the cost of housing getting further and further away from where the wage increases are makes house hacking more important. If you can buy a house and the price is getting further and further away from wages, but you have the benefit of a lower down payment, first-time home buyer options, 5% down options on single-family duplex, triplex, and fourplex that start November 18th, 2023, to buy something, a house with an ADU, or a triplex or fourplex to live in and reduce or eliminate your housing expenses. This generally is most important if you make less than $100,000 a year. In some areas, if you make more than $100,000 a year, you can increase your income enough to where the house hacking, reducing your living expenses, isn't as important. But for 98% of my career, I never made more. I'm trying to think. I don't think I ever made more than 50,000 until, no, 60,000, like 2019, 20 and 20, 21 and 22, I started making six figures. But those were the first years where I actually had so much financial freedom that my employer said, we better start paying him more or he's going to quit. And I did anyway. But there was a significant amount of time where when I started teaching at the CDL school, I was making $17 an hour. When I bought the first duplex, I wasn't even making $20 an hour yet. I had saved up and I used a owner-occupied loan product to not only get the better down payment of 5%, but to get the better interest rate. So if you can use a better interest rate to keep your home payment less, because what this doesn't show with home prices going up and wages not going up as fast is rents. Let's look at how many times rents have dropped so that people who aren't making enough can go and rent because it's so much cheaper than living in a house that you buy. You have a choice. You can pay your mortgage or you can pay someone else's mortgage. Or as Dividend Dave pointed out, you can have your tenants pay your mortgage. That's how many times rents have dropped since we started tracking the data in 1940. So, increase your income. Use owner-occupied lending if possible. If you can't increase your income enough to make house hacking not as relevant, and the more expensive, the high cost of living area that you live in, the more important house hacking becomes. It isn't going to be easy. There is hardly, I've only heard this once now, and I usually say I never heard this, but this morning I actually heard an investor say, now is the time to buy. I think it was on Coach Carson's channel, and he had a female guest on who, I forget her name, but they are investing, I think, north of Dallas, and they're pulling money together and buying in all cash and then refinancing later. And she is saying it's like being a kid in a candy store because it's the right time to do it there. First time I've heard an investor say now is the time to buy. Normally it's every year, every single month. Here's a reason for the next crash. This is the hardest time to buy. In 2011, you would think right now we can look back and go, that was the bottom of the market. It must have been easy to buy. Lenders vanished. And all we were hearing was double dip recession over and over and over. So people didn't think you were going to be able to buy and couldn't buy unless they can get lending, which was really hard to do. Increase your income, consider house hacking because it gets you on the property ladder. Let me tell you why. And there are some things that I'm going to talk about that matter to homeowners, but remember, almost everything I'm saying applies to that investor that wants to be able to continue investing in real estate as prices continue to go up. If we don't see the crash that all the crash bros and sisters are saying we're going to see, and your wage doesn't go up enough. How do you get that fourth rental or seventh rental? But if you are a home buyer, here's why you might want to consider buying a house. Because if we are currently watching home prices continue to go up and wages not go up as fast, that means that every single day is the closest you will ever be to home prices and wages being close together if they're every single day becoming farther and farther apart. Net worth from the source of this is quoted at the bottom. Can't grab my screen to make it move. Why are you doing this to me? There we go. The Fed. So the source of this is at the bottom. The last net worth I heard was at the age of 65, net worth on average was $221,000 if you owned a home, $6,800 if you are a renter. But this is data from the Fed. Homeowners, this might be a motivation to get on the property ladder. If you are an investor, here is how, as an investor, we beat the home values going up and our wages not. House hacking gets you on the property ladder. You can repeat it every more than a year. One of the requirements to doing owner-occupied lending is that you have to live there a year. So Matt, the lumberjack landlord, has house hacked 9 times. I'm in my 3rd house hack. So it doesn't have to be every other year. I house hacked once, and then it was about 8 years later that I did my 2nd house hack. And then when I retired, I did my 3rd house hack to actually move to where I want to, right on the water, walking distance to the ferry. So if I'm really stupid one day, I can go to Seattle again, because waterfront's actually not too bad. But I moved into this house hack because it's where I wanted to live, not because of an actual financial impact that it's going to have, which it sucks. It's just going to make me a bunch of more money. So consider that. Second is, do you have to live where you are? Housing is affordable. It's just not affordable where most people want to live. I should have gotten this picture too, but there's a significant amount of people who live on the East Coast, and then there's a significant amount of people who live on the West Coast, and then there's this section in the middle where very few people tend to live. Like something like less than 9% of the population lives in what you call the middle of our country, as far as the US goes. But can you move an hour or 2 further out from the major city that you're closest to so that you can bring your expenses down? Especially when we consider the fact that remote work is now more of an option than at any point in time. But here is the actual strategy that allowed me to, and again, I'm going to talk about, I started investing in 2013. My wages stayed the same until about 2020. 2019, they might have went up a little, but for those first 6-7 years, I wasn't making significantly more money, but homes started costing a lot more. But here's what happened. I house hacked in 2013, which significantly reduced my cost of living so that I could save more. Pretty much over doubling what I was able to save every month. By 2015, rents had increased. My mortgage hadn't increased much. I think that was actually a time in 2017 when taxes went down in one of the counties that I invest in. So my mortgage went down, not a lot, but like $40-something a month. But by 2015, I continued to make money. I continued to work a side hustle. There is a bigger gap between prices and wages. My wages hadn't changed much yet by 2015. But I had house hacking to increase my saving. In 2015, I acquired another duplex, which cash flowed. By 2000, almost 17, it's a year and a half later, I bought another duplex because the cash flow from the rentals, the reduced living expenses from house hacking, and the increased income by trying to change my income at my company by climbing the corporate ladder, my wages, well, they didn't just go up, the cost of living rate, the annual cost of living rate that most people see. I changed what I was doing at work. I was making more money from cash flowing assets, and I was house hacking. Then in 2020, bought a fourplex, second house hack. This significantly increased my income because I moved into a cash flowing house hack, and the one I moved out of was cash flowing as well. So the strategy is, over a 10-year span, home prices will continue to go up. So I'm not making a prediction. Remember, looking forward, nobody knows what's going to happen. I'm using the example of the last decade to show that home prices consistently continued to go up. Wages did not. So I use the strategy of house hacking, increasing my income, developing a side hustle, and acquiring, this is the third prong of this attack, acquiring cash flowing assets. And you saw the chart with rents that have increased over time. I've invested planning on rents to go down 50% and still not having to go back to work. We've never seen it. We've never had a rent decrease market-wide in Class C and B rentals. There are some specifically close areas like Detroit when the car manufacturers moved away, or Silicon Valley when the dot-com crash hit. It really impacted that area. But market-wide, we haven't. So I diversify my portfolio by investing with my properties more than 10 miles apart. I diversify and I make sure that they're 10 miles apart, close to several economic drivers, right? 3 or 4 of them: a base, a port, college, hospital, Boeing, Amazon, large population. And then I diversify my tenant base. I keep about 1/3 military, 1/3 Section 8, and 1/3 working or retired. And I keep a leveraged position to where I could handle my rents going down by 50% and still not have to go back to work. At the end of a decade of prices increasing and wages not, I'm still able to acquire cash flowing assets. If you're starting today, we're talking about in the next 10 years, every year or couple of years, you either doing something like a house hack or acquiring another rental, or maybe changing companies to increase your income. This is a multiple pronged approach to dealing with the fact that for the last 10 years, this happened, and it's more than likely going to continue, since in the last 2 years, we've created more currency than what existed for the 200 years prior to that. So inflation alone should make homes cost more, let alone limited building, the rate lock that is going to continue to force pressure on houses. If you can start getting on the property ladder when it's harder to buy a home, which makes it likely, don't count on this, but makes it likely that rents will increase, and you keep those assets over years, in the next 10 years, in 2 years or 4 years, when this chart gets worse and home prices seem further away from wages, you'll still be one of the people able to acquire the next cash flowing asset by using owner-occupied loans when you need to, increasing your income, maybe working remotely, and using the cash flow from your assets so that your income is not tied to the average income increase that everyone else is. You have your income, your side hustle, and your cash flowing assets to keep up pace with what's happening to asset prices. If you want your questions answered, I do live streams right here on my YouTube channel, Dion Talk Financial Freedom, every Tuesday at 4 p.m. Pacific. At 4 p.m. today, I'm doing a members only live stream where we look at deals, my deals and your deals. And Frank and Cynthia sent me one that we're going to look at today. So you can show up if you're a member to that. That's already posted. I will be putting a Zoom link in the comments. Thank you very much. Until my next video. Thanks for coming to my Dion Talk.